All right, yep. Good morning, everyone. I'm Stephanie Benvenuto, a member of the San Diego Housing Commission Board of Commissioners. It is 8:03 on January 12th, 2023, and we're going to call to order the special meeting of the Housing Commission's Investment Committee. This process for today's meeting is authorized by Government Code Section 54953E, added by Assembly Bill 361, and it allows the committee to use teleconferencing and provide the public with an opportunity to address the committee through call-in or internet-based options during a proclaimed state of emergency. The San Diego City Council on December 13th, 2022, and again this week on January 10th, 2023, declared that the state of emergency continues to directly impact the ability of members to meet safely in person. The council also declared that this applies to all boards, commissions, and committees of the city of San Diego. So this meeting is occurring by video conference with all committee members and commission staff participating by video. I'm going to go ahead and ask each committee member to indicate their presence as I say their name. Keely Hubbard. I know she spoke up before. Commissioner Melinda Vasquez.
Here.
Great. Commissioner Hubbard, you want to try one more time? Maybe you're come off mute.
Sorry.
Nope.
On mute.
Great, thank you. There are no members of the public in attendance, but members of the public may watch the video conference and hear the audio of today's committee, which is streaming live online. The agenda for today's meeting included a link for the website for the San Diego Housing Commission Board of Commission meetings, where the public can access the live streaming for today's committee meeting. The public has been provided with an alternative opportunity to provide comments to the committee through an online comment form and a toll-free phone number. A link to that comment form was included on the agenda for today's meeting, which is posted on our website, www.sdhc.org, on Tuesday, January 10th, 2023. The agenda and public comment form explain that comments about items on the agenda will be read into the record if submitted by 4 p.m. yesterday, January 11th. Non-agenda public comments submitted by 8 a.m. this morning will be read into the record. And in addition, members of the public who wish to listen to today's meeting by phone and speak on an item may call the toll-free phone number included on the agenda. That toll-free number is 833-548-0276. When prompted, callers should enter the meeting ID number that's on the agenda. That ID number is 977-1188-2092. A participant ID number is not required. Just press pound. Members of the public will remain muted until called upon to speak. When the comment on agenda public comment or an agenda item is introduced, those who wish to speak press *9 on their phone and raise their hand. Staff will inform callers when it's their turn to speak. When that occurs, caller needs to press *6 to unmute themselves. If a caller begins to comment on an item that's different from the item that we're currently considering, they will be muted and asked to raise their hand at the appropriate time. Members of the public will have 3 minutes each to provide their comments, but if we have a large number of callers wishing to speak on a single item, comments may be limited. Members of the public may also watch video of today's meeting through live video streaming available through the Commission's website, www.sdhc.org. Today's agenda included a link to the website for the Housing Commission Board meetings where the public can access the live streaming for today's meeting. We'll begin this morning with non-agenda public comments. As I mentioned, the toll-free number is 833-548-0276. Callers who wish to provide non-agenda public comments should press *9 to raise their hands. This is the time when members of the public may provide comments to the committee about topics that are not on today's agenda, but involve a subject within the committee's area of responsibility. The committee cannot take action on non-agenda public comments. No written non-agenda public comments were submitted for today's meeting, but I will now ask Vice President of Communications, Scott Marshall, if there are any callers for non-agenda public comment.
Unknown caller.
Apologies. Good morning. We did not have any hands raised to provide comments this morning. Thank you.
Thank you. This concludes the non-agenda public comments. Now I'll ask if any committee members would like to make any comments. Seeing none. Okay, we will move on to the minutes. We now have the approval of the minutes from the meeting of May 5th, 2022. Members of the public who wish to comment on the minutes should press *9 to raise their hands. We did not receive any written public comments. Do we have any callers at this time?
We do not have any hands raised for comments on the minutes. Thanks.
Wonderful. This concludes the public comment period for the minutes. Sorry. Do any committee members wish to make any changes to the minutes, or do I have a motion? Thank you. I'll go ahead and second. So that was a motion by Keely and I'm sorry, a motion by Commissioner Hubbard. Apologies. And I seconded. I'll go ahead and call the vote. For the record, I'll ask each committee member to say their vote on the motion when I state their name. Commissioner Hubbard.
Aye.
Thank you. Commissioner Vasquez.
Abstain?
Thank you. I will add my vote in favor, so that motion carries to 0 to 1, right? Did I repeat that correctly? This morning, we have 2 informational items on the agenda. The first is the fiscal year 2023 first quarter investment results. Members of the public who wish to comment on this item should press *9 to raise their hands now. No written public comments were submitted regarding this item, but we'll take those public comments if we receive them after the staff presentation. That will come from Chief Financial Officer Suket Dayal. Whenever you're ready, Suket.
Morning, commissioners, and thank you. Welcome to the new members. Just wanted to quickly go over this committee. On a quarterly basis, we provide an informational report to the board on our investments. And then this committee meets twice a year to discuss our investment portfolio. I wanted to introduce the team real quick. Crystal Vanderwood is our Vice President of Financial Operations. Amy O'Connor will make the presentation as the Manager of Accounting Operations. And Jan Hall is our Principal Audit Analyst. We also have Joe Foyer, who's a Senior Vice President of Mishler Financial Group. And Joe is our SDHC's financial guru and advisor and close friend. So start off with Amy, whenever you're ready.
Okay. Alrighty, thank you, everybody. My name is Amy O'Connor, and I'll be going over the investment results for Q1 FY23. Oops. Our portfolio at the end of September 30th, 2022 was 166.33 compared to 1.7835 of the previous quarter. That's a 12% or $12 million decrease from the prior quarter. We had 25.56 million held in various cash accounts and 38.37 million in investment funds. Pooled funds include the California Local Agency Investment Fund, LAIF, and the San Diego County Investment Pool. And the blended yield on these accounts was 1.13. The core investments on the account was 102.4 million. See right here. And the blended yield on that was 1.69. And let's see.
Amy, sorry, your screen sharing is not working right now.
It's not?
No.
Yeah, I don't think, yes. I
Oh,
don't
I'm
see- I don't see
sorry.
it. Okay.
There we go.
Is that better? Okay. I'm so sorry.
There we go. There we
So
go.
our core investments was at 1.66.33 million compared to 1.7835 of the previous quarter. And here you can see our cash and investments and our agency bonds of 102.41 million. The decrease of 12.02 million from prior quarter basically was due to, we received 1.4 million related to bridge shelters and other homeless programs offset by the issue of 6.4 million in program and administrative payments related to HSAP and 7.2 million in loans made to multifamily housing and first-time home buyers. And that's all I have. Oops, I have here, we have asset allocation by quarter. You can see, make that a little bigger. Our core investments was 61.57% of our investments. Cash, 15.36, LAIF 9.6, and the San Diego County Investment Pool funds of 13.45. And that's all I have for this morning. Any questions or comments before we go to Joe?
I will throw you a softball.
Okay.
Got any hands up? That all sounds very positive to me. But talking about the blended rates that you were highlighting for those various components, is this as positive as it seems? We are in very sound territory. Are any of these components cause for concern, especially watching some of the uncertainty in the economy going forward?
I will let Joe answer that. He's our expert.
No, as we'll get into in my part of the report, we are continue to be in compliance with HUD's PIH 9633, and including our own internal San Diego Housing Commission investment policy. And typically, you'll see that our yield to maturity is rising significantly because of the higher rates. And because we are not a total return portfolio, we just buy to hold. And so, to help manage cash flows, the operations of the Housing Commission. So as rates have been rising, some of the older bonds have matured, the lower book yield bonds have matured, and we've been reinvesting into higher rates. So we welcome the higher rates, and you'll see in the graphs. I mean, we've seen in the past some of the charts that we were in that long period of very, very low rates. And since we don't trade in and out, we can't take advantage of certain conditions in the market. Being a government portfolio, we're kind of locked into just given what the rates are. And so our portfolio, we welcome the higher rates. We welcome them. We want them. And Suket and Amy have done a really good job of reaching out and securing these higher rates because, and we'll get into a little later, there comes a time when the Fed will have to start reducing rates. And so we're trying to kind of lock in a rate. But no, to answer your question, sorry, it was a long answer. There is no concern. And we're set up perfectly for a higher rate environment, and we're in compliance.
That's fabulous. Always want to be in compliance. Thank
you. Yeah, good question. Yes.
Well, it's hard to tell given kind of the varying degrees of concern that you're hearing, out there. So I think that was very helpful. And I realize now that I also skipped over asking Scott if we had any public comments. Scott, did we have any callers on this item?
We do not. Thank you.
Okay. Well, that concludes the public comment period for this item. Committee members, do you have any other questions? This is an informational item, so there's no action required. But great time to ask some questions, or we can move on to our next item. Okay. Well, our next item is the current investment market conditions. Public who wish to comment on this item can press *9 to raise their hands. There were no written public comments submitted, but we'll take any public comments following the presentation, which will come from Joe Foy, Senior Vice President of Institutional Fixed Income and Equities for Mishler Financial Group. Whenever you're ready.
Waiting for public comments. Are we good to go?
Nope, we'll do those after your presentation.
Oh, okay, yes.
Sorry about that.
No, that's okay. Good morning, everyone. I'm here to present our core portfolio and discuss some of the current conditions of the markets. So when we do invest, I'll present what we invest in and how we're performing in the core portfolio. So if we could scroll a couple pages up, forward one more. Here we go. Okay, so comments in the past, the committee members have always liked seeing a snapshot of where we are and where we've been. And so from this page, you can see that over the years, where our market values have been, income, yields, and effective duration. So presently, as of 9/30 of 22, we were at 100 million, 931, 243 in the core portfolio. Now, a little clarification. This will differ a little bit from what Amy just presented. She presented 102 million and change. So if anybody was drilling down, what had happened was at the end of September, we had a bond that was going to settle on October 4th for about 1.6 million. And our safekeeper had went ahead and delivered into our account early the bond. So it got captured as a quarter end item. So that's why if you're looking closely, that number is not going to match what Amy's is. But so Amy's is correct. It was just that they put it into the portfolio, into our account early. So both numbers are correct. They're just kind of snapped at a different time. Jen and I had spoke about that when we were reviewing the report back in November. So at that time, we were at 100 million, 931. Our annual coupon, that number is static, so it doesn't take into account of reinvestments of about 3.1 million a year. Our average coupon, as shown, is 3.01. Our portfolio yield is 1.69, which from our last meeting, we were at 1.3. And at that time, I said we should see a pretty good bump. And going forward, we should see some significant higher, the book yield going higher. As like I said earlier, Suket, Amy, and I have done a good job of taking advantage of these higher rates. So our next meeting, that number will be a lot higher. Our duration is at 2.28. And again, duration is just basically the price sensitivity of your portfolio, given a 100 basis point move up or down. And so the lower the number, the little more less reactive it is to movement in rates. However, since we are our investment policy is conservative by nature, we use it more for like an average maturity number, not necessarily a pricing component of risk. And so this is a good gauge for us to see, okay, where are we at in our average maturity? What are we expecting from the Federal Reserve, whether it's Fed speak or actually moving rates higher or lower? What are we seeing in the market to give us a better idea of where we might want to, where on the yield curve we might want to buy, make purchases. And so in the current environment right now, we're trying to extend duration. It's a little bit difficult. We're trying to extend a little bit because I think I'm in the camp that believe that, with this rapid raising of Fed fund rates, I think, and we'll see in charts I'll present a little later, that there's going to be some payback and we are going to be going to lower rates. When that is, early 24, we're not sure, but it'd be nice to lock in some rates so that we're not having, 50% of the portfolio maturing at a time when we've gone to lower rates. So, so that if you look at the chart below, you can see, so what I did was I took a snapshot of the 2-year since our last meeting. And you can see we've gone significantly higher in the 2-year as the Federal Reserve has been very aggressive in trying to get a handle on inflation. Next page, please. So these are our portfolio characteristics and distribution. I really like this page. For government portfolios, it's a little bit limited, but it still serves its purpose. You can see our maturity schedule in the bars. We're kind of investing pretty heavily in the 2 to 4 year range. So some might ask, well, why are we not investing a little bit shorter term, 1.5 years and in? And the simple answer is we keep 40 to 50% of our portfolio in overnight monies. So really there's not a need to make purchases because remember this portfolio is less cash. There's not a need to make purchases in that space because the rates are lower, and hence so we grab the 2 to 4 year area to try to maximize our yield because that is part of our investment objective, right? Safety, liquidity, and yield. And so that is the best place for us in our portfolio. The other chart says effective duration, and I include that because our bonds pay monthly, principal and interest. So what it does do, it's a little bit more conservative. It reduces some of our duration so that if we were in a lower environment, we wouldn't lose as much. So you can see everything comes up forward. And so it just makes it a little bit more conservative approach, but it's nice to see that we are a little more front dated than the actual maturities. Next page, please. So I always like to include the holdings report. And it shows that how when we do invest, we try to what we call laddering. We attempt to have a security for every month of every year. And while not always perfect, it's not quite as essential for us because we do have monthly pay on our bonds. And so if you kind of scroll the next page or two, you can see that we have a maturity for just about every month. And again, it's a standard practice. It's nothing that I invented. It's just a standard practice for portfolios, especially government portfolios. So it ensures that we do have an adequate monthly cash flow to meet San Diego's operational needs. Next page, please. Okay, so last time we spoke, it was all about inflation, and inflation's still among us, although this morning's print continues to show we are starting to tick down a little bit. So I thought I would spend a moment to show what the Feds have done, the Federal Reserve has done since our last meeting. And you can see that they have, after their initial little bump there in March, they have raised rates by 75 basis points 5 times. And then most recently, they've kind of moved in a little bit and only done it 50%, 50 basis points. There are many market participants, including myself, that would like to see the Fed pause a little bit. They admittedly have said that these types of actions, there's a little bit of a lag for the effectiveness, and you'll see in the coming charts that over the years, history shows us that aggressive moves up tends to the Fed has to ease quite significantly thereafter. Next page. And so here you can see I went back to 97. You can see some of the aggressive moves higher. Say in the beginning of the chart, we hit 99. We had the whole .com, and then of course the .com bust, and then the tragic 9/11. And so we lost rates down into 2002, 2003. We had the recovery. So you can see from 2003, 4, they ratcheted rates, but from 1% to over 5%. However, then we had the housing crash. There was a lot of us talking, in 06 that maybe we ought to pause here, but they kept going. And you can see, after the 2008-07 crash, had that long period where they didn't do any tightening because we were not in shape to do that. And then again in 16, they started raising rates, and we were, halfway through. We said, well, maybe we ought to pause. Unfortunately, they did not. They're very intelligent people. I mean, men and women. Sometimes I think they get caught in the forest. Because history shows you that it happens quite frequently. And so then again, they had to ease, and now we're on this final leg here where we're tightening. So you can kind of see where that's going, right? That perhaps that they're probably going to have to ease rates again. And and the whole idea of the Federal Reserve is monetary stability. So thinking outside the box, you would think they would just, okay, let's stop a little early. Maybe we wouldn't have to take all these drastic actions going forward. Next page, please. Okay, a little redundant, it is, but I went back to 65, and you can see what I was speaking about in the 80s. Right, energy costs were high, rates were close to 20%, if you can believe that. You always hear these stories of homeowners that had a 17% mortgage rate. Just couldn't imagine, right? But you can see where I circled the dots, where we just seen the previous graph of where it ratcheted up, had it decline, ratcheted up, had it ease, ratcheted up. So I think my point is taken that perhaps, and other market participants say perhaps they ought to just take a pause here. Next page, please. Okay, so as of our last meeting, what's driven this is inflation. I chose CPI instead of the PCE this time, just because this is more what consumers see when we go to the grocery store, et cetera. And I put a red line there for 2%. That's the Fed mandate that they've talked about perhaps revising, but they don't want to lose credibility. So they're going to stick with the 2%. But as you can see, the jump in inflation, however, has receded somewhat. And this morning, we had a print of down to 6.5. So we continue to see a little bit of a drop in inflation. Hence some of the speak of perhaps. Actually, there was quite a lot of speak this morning commentary about the next Fed move in February, but maybe just doing 25 basis points versus the 50 versus what was the 75. Next page, please. Went back to 65. So you can see that our current rate, our current CPI, is significantly high. You have to reach back all the way into their, the early 80s to see that the consumer price index was this high. Next page, please. So what does that do with the Fed funds raising rates? And because the inflation rate is so high, well, it directly affects short-term rates. And in this instance is the 2-year, since we buy bonds off the 2, 3, and 5 years. So I thought this would be a nice view. So in 1 year's time, you can see we've gone from under 1% on the 2-year to about 4.25. Quite a move in 12 months. Quite a move. And but like I was speaking earlier, we welcome this move though, because we can reinvest our proceeds into higher rates. And if we're getting 100 to 200 extra basis points, that's money for San Diego Housing Commission to use that they need for operations. So we welcome these high rates, to be honest. Next page. Thank you. Went back a little further, and you can see how high at 4.25 is as high as we've been again since the housing crash, prior to the housing crash. So it is a significant move higher and quite rapid. Next page, please. Again, a little redundant, but you can see, going back to 76, where we're at in comparison to previous years. Next page, please. So what's the 10-year doing? That's another index we call, even though we don't buy anything off the 10-year, it's always a discussion piece because mortgage rates, correct? So as you can see, the 10-year has not moved quite as aggressively as the 2-year, which is typical of a rising rate environment. We have about 180 basis points year over year. And it has affected some of the housing market. With the loans now, that I saw that we were at 5 7/8 for conforming and 6 1/4 for non. So that has slowed the market down a little bit. Though here in Southern California, as we all know, we're in a little bit of a bubble ourselves, right? There's lack of inventory. So while sales are flat, prices have been holding firm. But I thought it was interesting to show you that, while the 2 years is jacketed up, the 10-year has not moved quite as significant. Next page, please. And long-term going back, you can see, like I spoke earlier, in the 80s, mortgage rates being really high, 10-year is very high. But you can see the long-term trend, right, of the 10-year, these last 50 years has trended lower. Kind of broke through that this year, but fully expect that to probably be lower again sometime in 24. Next page, please. And so we've spoke about this before. This is the relationship between the 2-year and the 10-year, and the significance of it. We've had many discussions. And the red areas is when we have what we call an inverted curve, where the 2-year has a higher rate than the 10-year. And the significance of that is it typically precludes a recession. And you can see in 2000, right before, we were printing negative GDPs and before 9/11. You can see that we were inverted and kind of finally came out of that. And then again, 06, 07, we had a slight inversion. And then now currently you can see on the far right, I think we're at 72 basis points, the 2 years higher than the 10-year. So does that tell us we're headed that way? Maybe, maybe not. A few differences this time around from others is employment is still strong. The employment rate is low. Still hiring at 200,000 plus a month. Granted, there are sectors, that are laying off, but overall, and there is a labor shortage, but overall, the employment is strong. So that is kind of a little difference here on this having an inverted curve, and perhaps though we can have what they call a soft landing, where after all these price hikes, rate hikes, that we're able to not destroy the economy. I think GDP has been still, was our last GDP print 3.2. So we're still in pretty good shape of for the Feds to try to reach their mandate of lowering inflation. Next page, please. So here's kind of funny looking graph. This is implied overnight rate hikes for the Fed. I tried to overlay from our last meeting, but it looked kind of muddled. But this graph, you can see where they anticipate the Feds to stop raising rates at the top of the orange bars, and then perhaps begin lowering rates. And this is all real money. These are all overnight. These are futures where money's being placed. So this is a lot earlier than what most economists or other type of asset managers are planning. But it does show you where real money is trading of a Fed ease or stopping sometime in the middle of 2023 this year. Next page. So every quarter, the Federal Reserve, they bring out their economic projections. I wish I had a pointer. You can see the first line, the change in the far left in the median. You can see that they back in September projection, they had a 0.02, and now they're considering GDP to go to 1.2 in 23. And the employment rate, they're expecting to go higher in 23. Inflation, again, they're using PCI, I use CPI. It's at this point it's basically the same. The projection is now at a 3.1. So they feel like that they're going to be able to get a handle on lowering inflation. That's pretty aggressive to think, but they are trending down. And then finally on the bottom, you can see the Fed funds rate. September, they felt we'd be at a 4.6 in 23, but now currently projected 5.1. So, and the market has priced in over 5%, but you can see in 24, they're expecting to lower it by 100 basis points, but that's significant. And that goes back to what Suket, Amy, and I have been planning for, is to try to lock in rates and try to extend our duration so that in 24, when rates begin to get lower and we have to reinvest, that we're not, perhaps we have less to invest in lower rates. So if we can grab these higher rates now, it would be in the best interest for the Housing Commission. Next page, please. This is the day I printed this the other day. You can see, I thought I'd just take a snapshot of world bond rates. It's sort of by the 2-year. You can see the US at number 7 at a 425, but it kind of brings into light what the rest of the world, their 2 years trading at. I mean, even Japan is not negative any longer. The same with Switzerland. They've been negative for decades. So you can see it's just not us, it's globally where, once our Federal Reserve began raising rates, you see the EU and Great Britain's, they all started raising rates as well. Next page, please. Last page. And again, this is data I printed it back on the 6th, but you can see the effects of, especially the NASDAQ, the 1 year change down about 30%. However, as rates recede and as they begin to be less restrictive, I think perhaps we should see about the equity markets have been very resilient through all this and in previous downturns. I don't expect it not to recover. When is the question? I don't know, but hopefully sooner than later. But anyways, I thought I'd share that last snapshot with you. So that concludes my presentation. I guess in summary, I would say that we are, in compliance with all our with HUD's policy and our internal policy. We welcome the higher rates. so that we can reinvest in higher rates. And I think we're in a good shape moving forward for 23 and 24. Thank you.
Thank you for that. Scott, do we have any callers?
We do not. Thank you.
Okay. That concludes public comment on this item. However, committee members, do we have any questions or comments? This is another informational item, so there's no action required, but now's your time for questions.
Nice. Thank you for the report. I have no questions.
Thanks,
Thank you,
Ely.
Commissioner Hubbard.
I do have a question.
Okay.
It's
Hi.
not superficial, but thank you, Joseph, for the presentation.
You're
I
welcome.
noticed that when you were looking at the different countries raising of the interest rate, is there a correlation between the United States raising rates, and so because we set the trend, that's the reason why they're doing it, or is it more of like an independent decision because the economy is what it is, right? Like I want to better
A little bit of both. Good question. A little bit of both. Since we are globally connected, and I think the world everybody has been facing the higher inflation, whether it was from the supply crunch felt worldwide, and caused by different pandemic, etc. And so every country has their own set of standards of where they want inflation to run in accordance with their economy. So typically, not always, but typically the U.S. has always led in either raising or lowering rates. It's just and so then the EU and others will feel in the same effects, and they will follow. And I think they do hold discussions. When the Fed started first raising rates recently, there were a few countries that were a little anxious about that because their economies were teetering as it was, and so I not privy to the information on this, but I know they had meetings about that with other Federal Reserves throughout the world. And but at the end of the day, I think every country needs to do what's best for their country. Do you want to be cooperating with the other countries? Of course, right? It's a global economy. But soon thereafter, we saw the other central banks follow what our Federal Reserve had done. So yes, we all to answer your question, there is independence, but there is a global connection, and I think they have their discussions to try to best have a stable monetary policy, best they can to stabilize the inflections.
Thank you.
You're welcome.
A great question. Thank you for asking.
It was.
There's no easy answers for you, huh?
Well,
We're all very
so yeah. The comforting thing is because we have a very conservative policy. It's pretty straightforward. I mean, not to simplify, but it's pretty straightforward. We have well-defined market sectors and maturity limits. So it's the challenge is, we're always in compliance, but the challenge is trying to maximize our yield within policy. That's the challenge.
Yeah. Absolutely. Okay, well, are there any other questions? Thank you for the reports, Joseph and Amy.
Thank you.
This concludes the committee's special meeting today. Barring any other comments, we will adjourn at 8:42. Thank you, everybody.
Thank you, everyone.
Thank you, everyone. Thank you.
Thank you.
All right.
Nice meeting you.
Nice meeting you.